You know, in the middle of a good time, so concerns about a new bubble, a real estate bubble, as record levels of risky loans are being given out. Ronald Reagan's former budget director, David Stockman, says these bubbles are popping up everywhere in housing, bonds, stocks, and they're all linked together by worries that you should have now. Well, something's going on here.
Yeah.
Record lending, easy lending at that, or certainly easier. But the proponents of this say, well, it's certainly a hell of a lot better than it was prior to the meltdown, the thing that triggered the meltdown. You say what?
Well, I say it's 207, 208, all over again, party time. We have bubbles breaking out everywhere and almost a repeat pattern. Take a look at the Russell 2000. That's the small cap Main Street companies of America. In the last year, they're up 43%. Their earnings are up 0. They're trading at 75 times reported net income, which is a crazy valuation. And it's very similar to where we were in the fall of 2007. Take junk bonds. This year, junk bonds and loans are having a massive surge recovery. 1.3 trillion will be issued this year, 4 times more than 2009 when we were sobering up, and far more than 2007 in the last bubble. Take a look at the stock of the year. Fannie Mae is up 1,200%. And it's a bankrupt, insolvent ward of the state that would be a multi-trillion heap of waste without the taxpayers. You know, without the taxpayers.
But what do you say to those who look at the major aggregates and say, all right, the S&P and the Dow, maybe 15 or 16 times earnings, rich but not obscenely so, a little bit above the historical norm, not ridiculously so. So those pockets notwithstanding, and they're not just pockets, they're noteworthy. No. But that in the aggregate, it's not so bad.
No, but if you look at the leading edge of where bubbles form, they don't form in the heart of the Dow. They form out on the speculative periphery of the economy and then work their way in. And on the periphery,
so you think these are creeping into the major markets?
I mean, people think housing is recovered, but 50% of sales are funded with cash. The normal healthy rate is 10%. The rest is mortgages. Why? Because first-time buyers are out. They're sunk in student debts. Resale buyers, move-up buyers can't move up because.
So you don't buy this housing recovery?
No, I think you have massive speculation by LBO funds, guys riding into Scottsdale, Arizona on the back of a John Deere lawnmower in a $5,000 suit. And what do they know about crabgrass in the lawn? Or
there are suits that cost $5,000.
Yes, right, exactly.
All right, well, let me ask you.
So the point is, this is 2 or 3% money from the Fed.
Yeah, but it can't explain
a
nationwide recovery in real estate. Not robust, but certainly off the mat. So some of that has got to be genuine and legitimate.
Oh, yeah. Some of it is due to the fact that the Fed drove the 10-year bond rate down to 1.6. With it came the mortgage rate. We got mortgage
forced
rates.
Interest rates
we
lower.
Forced interest rates to rock bottom, sub-economic, really lunatic.
So what happens
low.
when that party ends?
And so therefore everybody refinanced. There was some activity in the housing market, and in many markets prices are now back up in bubble territory, up 50, 100%, not on organic demand, on new jobs.
Yeah, but compared to 5 or 6 years ago, I mean, I'm not being an apologist for this, but yes, from where we were last year, but where we were 5, 6 years ago before any of this hit the fan, we're kind of back to where we were.
Yeah, but the point is, for 11 years, from 1995 to 2006, housing went up, house prices went up each and every month, 11 years in a row, by 200%. That wasn't normal. That was a bubble. It was partially corrected.
They didn't go up 200%.
They did. They went 200% in 11 years.
Okay. But then what do you see happening now? Then, if what you say is right, then where are we going?
We're in the fourth bubble created by the Fed with easy money and printing press expansion in this century. .com was a crash. It killed us. Housing was a disaster. We're now digging out, and it's going to be another. Wall Street went the meltdown and the recession of 2008. This is the biggest one yet. And when it busts, and it's only a matter of time.
It being housing.
When everything busts, the stock market, the junk bond market, the real estate market.
You think it's all going to happen together?
Of course. The biggest bubble of all
when?
is
Could you tell me when so people
Well, I wish I knew, but I don't, except I know that when you have the Fed buying $85 billion a month, putting the interest rate at 0 for 6 years is promising, holding down the entire yield curve in a totally artificial way.
But how artificial? I've often thought about this. Yeah, they are forcibly keeping rates low. How much higher would they be if the Fed weren't doing it? I suspect not a heck of a lot.
No, I don't think that's right, because the law of supply and demand has not been repealed. When you're buying $85 billion a month, which is all of the Treasury issue, every incremental supply of Treasury, okay, over half of the GSE, Fannie Freddie, is being bought in by the Fed.
I understand
that's supply and demand. But
if the economy is weak, as you said, then rates might not be that high after all.
Well, if the Fed weren't buying half of the Treasury issuance and all of the Treasury and half of the GSE, the supply and demand crossing. No, the supply and demand would clear the market at much higher yields, lower prices.
How much higher?
Well,
I don't think much higher.
I would say 200 or 300 basis points easily.
Really?
Absolutely.
3 full percentage points higher than now?
Of course. Yes, absolutely. And so, therefore, we need to get the Fed out of the market. I don't know if I'm right. I don't know if you're right.
I know your views on this, and you don't like the artificiality of all of that. But let's say the Fed then, under Janet Yellen, assuming that's the case, early next year, which seems to be the betting, maybe March at the soonest, starts indicating it's going to pull back on that 85. Let's say it's 65 billion, 60 billion, 55 billion, whatever it is. What do you think the market fallout would be?
Well, the market is going to have a huge hissy fit.
Even though they know it's coming.
Even though they know it's coming. They knew it was coming in May. Bernanke gave a small statement that we're thinking about maybe sometime down the road we might do something. There was a massive reaction, hissy fit. Some bond classes dropped by 8 to 15%. The emerging market bonds collapsed. And that then had to be walked back almost immediately by the Fed that was afraid of its own shadow. So I think the Fed has taken itself hostage. The market will have a violent hissy fit the first time Yellen says anything about sobering up.
Even though they know it's coming. They know it's coming.
But listen to every talking head who comes on who's a money manager, and they say, you party while the music's playing, but I'm a smart guy and I'll get out of the way as soon as I figure out they're going to try to do something back to normal. This is a destructive, dangerous monetary poison that's being put into the system. It is distorting all kinds of economic behavior. It's producing what we call malinvestments of a massive scale, and the worst of it is speculation on leverage by the fast money that's taking asset prices right up through the roof.
All right, Dave, on that happy note, always good seeing you.